Hello, Alex here today. This is chapter 5 of Accounting 201. So now we're on accounting systems. Okay, this is the intro. Really good intro for this one. Whether you realize it or not, you likely interact with accounting systems. For example, your bank statement is a type of accounting system. When you make a deposit, the bank records an addition to your cash. When you withdraw cash, the bank records a deduction in your cash. Such a simple accounting system works well for a person with just a few transactions per month. However, over time, you may find that your financial affairs become more complex and involve many different types of transactions, including investments and loan payments. At this point, relying on your bank statement may not be sufficient for managing your financial affairs. Personal financial planning software, such as Intuit's Quicken, can be useful when your financial affairs become more complex. That's a really good software to use. I still prefer QuickBooks or Excel. Excel is maybe for just minor accounting, but QuickBooks is really nice because you can do everything on the QuickBooks and then export it to Excel to flash it up. What happens if you decide to begin a small business? Transactions expand to include customers, vendors, and employees. As a result, the accounting system will need to adjust to this complexity. Thus, many small businesses will use small business accounting software such as Intuit's QuickBooks as their first accounting system. As a business grows, more sophisticated accounting systems will be needed. Companies such as SAP, Oracle, Microsoft, and Sage Software Incorporated offer accounting system solutions for businesses that become larger and with more complex accounting needs. So an example of this is governments and a lot of smaller companies will use QuickBooks, but when you get as big as McDonald's, Walmart, what happens is Great Wolf Lodge, they get so large that they have too many accounts at that point, so they usually develop their own software. And it just maybe using Excel and other third-party companies to create their own. So yeah, but usually QuickBooks is fine. QuickBooks is all around great. But that's still no excuse not to know what's going on behind the scenes. It's still good to do some manual entries every now and then. You got to know the manual way. So accounting systems used by large and small businesses employ the basic principles of accounting cycles discussed in the previous chapters. However, these accounting systems include features that simplify the whole recording and summary process. So in this chapter, we're going to discuss how to simplify procedures as they apply to both manual and computerized. So there's manual systems and computerized. Computerized is the exact same as manual, but in a computer environment, so it takes care of a lot more behind the scenes. Computerized systems do more behind the scenes entries. But that's why you have to know the manual, because if you don't know what the computer is doing, you're not going to be able to fix a problem or hunt down a problem or problem solve. You're going to just be like, oh, I don't know what's going on. I don't know accounting. So that's why we're learning this. Okay, so basically, an accounting system is the methods and procedures for collecting, classifying, summarizing, and reporting a business's financial and operating information. So that's all an accounting system is. It's just going to take transactions, classify them, summarize the results of those classifications, and then report it. That's it. That's the accounting cycle. That's why it's so important, because it's not just you that needs to use this data. It's employees, managers, bankers, investors, creditors, the government. They all would like to know how you're doing. And this is just language to tell them how, financially. So as a business grows and changes, its accounting system also changes in a three-step process. This three-step process is First, analyze the user information needs. Analyze what they need to record. What business, if they're in merchandising, they have to keep track of cost of goods sold. They have to keep track of inventory. If it's construction company, well, guess what? Construction in progress. You got to keep track of what's your labor costs, what's your materials costs. So not every business or person's going to need certain accounts. They're going to need only a select few at a time. Design the system to meet the user needs. So after you've designed the system and set up the accounts, then you'll know, oh, okay, they're gonna need an interest expense because they use interest. They have loans, they have credit cards, or they have an interest revenue account because they have investments that gather interest revenue. And then you implement the system. So after you analyze them, design them, implement. And that's how you make an accounting system. So you need internal controls. Internal controls are policies and procedures that protect assets from misuse, ensure that business information is accurate, and ensure that laws and regulations are being followed. Internal controls, we'll discuss it later on. Okay, processing methods are the means by which the accounting system collects, summarizes, and reports accounting information. These methods may be manual or computerized. So you want to learn manual first, then go to computer. So accounting system are manual or computerized. Understanding a manual accounting system is useful in identifying relationships between accounting data and reports. Also, most computerized systems use principles from manual. So most computerized follow exactly what manual would do. Okay, so subsidiary ledgers. A large number of individual accounts with a common characteristic can be grouped together in a separate ledger called a subsidiary ledger. The primary ledger, which contains all the balance sheet and income statement accounts, is then called the general ledger. Each subsidiary account is represented in the general ledger by a summarizing account called a controlling account. So you have the general ledger, so let's say accounts payable. That's the big time account. Then you have the subsidiary ledgers that drop down. So it's like a drop down. What is this big account made out of? That's the subsidiary ledgers. So out of all that payables, it'll break it down to exactly who you owe to. So you'll see all the vendors. Oh, Sunrise Company. Oh, John's Tires. We owe them all money. But all together, when you combine all that you owe, it equals one account, one controlling. Okay, so the two most common subsidiary ledgers, so the two accounts that are actually going to have subsidiary accounts are accounts receivable and accounts payable. So exactly how you owe vendors, people are also going to owe you money, customers. So you're going to have it broken down. Accounts receivable is the customer's ledger. Lists individual customer accounts in alphabetical order. The controlling account in the general ledger summarizes debits and credits to the individual customer accounts and the receivables. The accounts payable subsidiary ledger, or creditor's ledger, lists all the creditor accounts in alphabetical order and has the controlling account. And then you're going to have special journals. Special journals are designed to record a single kind of transaction that occurs very frequently. So that is provided services on account is the revenue journal. Receipt of any cash from any source, cash receipts journal. Purchase of items on account is purchases journal, and payment of cash for any purpose is cash payments journal. The all-purpose journal is called the general journal, or simply the journal. Excuse me. It can be used for entries that do not fit into any of the special journals. So that would be like if I traded you, if I had a business and I traded my business van for office supplies, that wouldn't be a normal transaction. It'd just be in the general journal, be a trade. No cash traded hands. I do believe in trades are a great way to do business also. Fees earned on account will be recorded in the revenue journal. Cash fees earned will be recorded in the cash receipts journal. So revenue is all cash on account or by cash. No, it's all the revenue earned on account. So all the receivables. And then cash receipts is all transactions that involve the receipt of cash. So usually when you're getting paid, someone's paying you on their account, then this would end up in the cash receipts journal. So when you sell something that's in the sales journal, revenue journal, and so you record the revenue and the accounts receivable, but in the special, because it's a special journal, you're going to debit the receivable, credit the fees earned, but you're going to combine them. So instead of doing two entries, one entry will represent both of those. So you just have a single column instead of double entry, because you always know whenever you put something in that account, any account that's in there is going to be affected to the receivable and the fees earned. The cash receipt is going to have normally three sections, or three spots to put it. One is cash, because people will always pay you cash, and the other one is so you'll debit cash, credit a receivable or an other account, which means they'll either be paying on account or it's just going to be more revenue. So it's like you're combining entries on that one. The purchases journal is all purchases on account are recorded in the purchases journal. Cash purchases would be recorded in the cash payments journal. So purchases is when you buy on account. So you're going to have the you're always going to credit a payable. So always going to credit a payable, but you're going to either debit supplies or an other account, which will be mostly office equipment or some other goods that not supplies. I guess you could have supplies. In this example, we have supplies, and then we have other account. The supplies is just for supplies, but the other account could be used for office equipment, what have you. Okay, the cash payments journal. All transactions that include the payment of cash are recorded in the cash payments journal. So this journal is going to have all your payments to the vendors. So you're always going to debit accounts payable. You're going to debit accounts payable, but you're going to credit cash. You're always going to credit cash. And you're not always going to debit accounts. You're always going to credit cash because you're always paying it on this account. But you're going to either debit payables, which you owe, or just expenses like utilities expense, rent expense. So that's what that accounts for, the cash payments. So computerized accounting systems. Computerized accounting systems are widely used by even the smallest of companies. Computerized accounting systems have the following three main advantages over manual systems. Computerized systems simplify the record-keeping process by recording transactions in electronic forms and at the same time posting them electronically to general and subsidiary ledger accounts. Computerized systems are generally more accurate. Computerized systems provide management with current account balance information to support decision making. Since account balances are posted as the transactions occur, so it's a little bit more up to date, a little bit more accurate over manual. But remember, garbage in, garbage out. And we have an example in QuickBooks how all you do is you set up an invoice, post the invoice, mail it, and when you get the payment, enter the payment, and then you can prepare reports right off that. So QuickBooks really streamlines it, but behind the scenes, you're still debiting receivables, crediting fees earned. You're still debiting cash when you get the payment, and crediting accounts receivable when you get the payment. And it's still using behind the scenes data to prepare reports. Okay, e-commerce. The U.S. Census Bureau indicates that e-commerce sales are over 130 billion in retail. This represents over 3% of all retail sales using the internet to perform. So 3% of all retail sales happen over the internet. So it's getting up there. It's a lot more sales over the internet because usually a lot more deals. Sometimes, always check online if it's better value. So there's talking about that segment analysis. Oh, and segment analysis. So accounting systems often use computers to collect, classify. Oh, yes. So you can have segment analysis, which is just, all it does is compare. So in this one, it has different segments of a business. And what you do is it shows the 2008 year versus the 2009 year, column by column. And so what it's doing is, this is an example of Intuit's business. And so they have it broken up into financial management solutions, payment solutions, consumer tax. They have all these segments of their business. And what they do is they compare revenues for each segment. And they can see who is increased by what per year or who is decreased in revenue. That's pretty interesting. And then what you can do is you can, by analyzing the increase or decrease, so find if you had an increase or a decrease. You can find if you increased percentage-wise or decreased percentage-wise. It has a little example right here. It's hard to see, but you see how it compares the percent. So you can see which segment performed better or worse from year to year or between segments. So very useful. And all you do by that, to find the percent, what you do is you find negative 2%. You would just, by comparing the percents, I'll go back over that a little bit. But yeah. So chapter 5 isn't too bad. It's just the accounting systems pretty much. Oh, and then another. So there's two different types of transactions: business to business or business to consumer. So business to consumer examples of companies are Amazon.com, Priceline.com, Dell Incorporated, where they sell products to consumers. Business to business transactions are, an example would be Cisco Systems, an internet equipment manufacturer, which would make internet equipment for maybe Comcast, CenturyLink, and Bristol Myers Squibb Company, a pharmaceutical company, which pharmaceutical companies sell to the pharmacies. So they're business to business transaction. And BMS. So yeah, e-commerce though has really helped because it streamlines purchases and payments, because it automates transactions and it eliminates paperwork. That's a big thing nowadays. But so that's chapter 5. Not too intensive. I'm gonna go into chapter 6, and I'll see you next chapter. I hope this helps. And if you have any questions, feel free to comment below or ask. And maybe I can help out, type an answer, give some clarification. So thank you very much.